Have you ever looked at a massive construction project, like a bridge, a stadium, or even a skyscraper, and wondered, how do accountants decide when to record the revenue for something that takes years to finish? Well, that's exactly what today's video is about. We're diving deep into long-term construction contracts under IFRS and ASPE. By the end, you'll know how companies recognize revenue, track costs, and deal with profits, or losses, on projects that span multiple years. And before we get started, don't forget to hit like and subscribe so you never miss out on these practical, exam-focused lessons. All right, let's get started. Most sales transactions are simple. Deliver the product, collect the cash, record the revenue. But construction contracts are different. They can take several years to complete, and performance obligations are satisfied over time, not at a single point in time. Under IFRS 15, revenue is recognized as performance obligations are satisfied. That means if the company can reasonably estimate costs and progress, it uses the percentage of completion method. If not, it falls back on the cost recovery method, which means that revenue is recognized to the extent of the costs incurred. Cost recovery method is also known as the zero profit method. So, how do companies keep track of all this activity? Let's look at the general ledger accounts first. Construction companies typically add two special accounts: contract assets, or construction in progress, where costs and profits accumulate. Progress billings, a contra asset that offsets the contract asset when invoices go out. Here's how it flows in practice. When costs are incurred, debit contract asset, credit cash or payables. When billing the client, debit accounts receivable, credit progress billings. When cash is collected, debit cash, credit accounts receivable. At period end, recognize cost of sales and revenue, moving profit into contract assets. At project completion, the contract asset and progress billings are closed out. Now that we know the mechanics, let's explore the two main types of construction contracts: cost plus and fixed price. A cost plus contract means the customer reimburses actual costs, plus an additional fee or markup. Look at the example of Summit Construction. Estimated costs are $750,000, with an 8% markup. In year one, costs of $380,000 are incurred. Summit bills the customer for costs plus profit, $380,000 plus $30,400. The journal entries would look like this: record costs, debit contract asset $380,000, credit cash or account payables. Record billings, debit accounts receivable $410,400, credit progress billings. Recognize revenue, debit cost of sales $380,000, debit contract asset $30,400, credit revenue $410,400. For the year 2, it's exact the same process and journal entries. In the year 3, the project is completed, and an entry is recorded to remove the contract asset and progress billings from the records. Cost plus is fairly straightforward. But fixed price contracts? That's where things get interesting. In a fixed price contract, the customer agrees to pay a set amount no matter the actual costs. This can result in a profitable project overall, a project that's profitable overall, but with a loss in 1 or more years, an onerous contract where total estimated costs exceed the contract price. The accounting process involves 4 steps. Estimate the expected profit or loss. Determine stage of completion, input or output method. Calculate revenue for the current period. Recognize cost of goods sold, expense. Now let's dive deeper into each of these 4 steps so you can really see how they work in practice. Step 1. Estimate expected profit or loss. Start by adding up costs incurred so far and the estimated cost to complete. Subtract this total from the contract price to find the expected profit or loss. Look at the Everest construction example. Contract $20 million. Total cost estimate $19 million. Expected profit equals $1 million. Once we know whether the project is profitable overall, the next step is to measure how much of the project is complete. Step 2. Determine stage of completion. 2 approaches are common. Output method. Based on value of work, certified. The company has to contract the services of a surveyor that will estimate the amount of work completed to date. Example: $6.5 million certified divided by $20 million contract equals 32.5% complete. Input method, cost to cost, based on costs. Example: $6 million divided by $19 million equals 31.6% complete. With the percentage complete in hand, we can now figure out how much revenue belongs in the current period. Step 3. Calculate revenue for the current period. You are going to use the formula current revenue equals percent complete times contract price minus revenue already recognized. Example: Year 1, Everest Construction. 31.6% times $20 million equals $6.32 million revenue. Step 4. Recognize cost of goods sold and profit. If profitable each year, cost of goods sold equals cost this year, and revenue minus cost of goods sold gives you gross profit. If profitable overall, but a loss in one period, revenue is still recognized normally, but costs exceed revenue for that year. If onerous overall, record the entire expected loss immediately under IAS 37. Example: in Everest's first year, revenue $6.32 million, costs $6 million, profit $0.32 million. Now that we've broken down the 4 steps, let's see what happens when costs don't go exactly as planned. It's very common for construction projects to go over budget. IFRS says you adjust your estimates prospectively, meaning only current and future periods change, while past years remain untouched. The key point is, a contract can show a yearly loss even if it finishes profitable overall. But what if the bad news is bigger? What if the whole project is now expected to lose money? When revised total costs exceed the contract price, the contract becomes onerous. IFRS requires companies to recognize the entire expected loss immediately, not spread over future years. Example: $6 million contract, revised total costs $6.25 million, $250,000 expected loss. That full $250,000 is recognized right away, and any earlier profits are reversed. Finally, let's talk about a scenario you'll definitely see in practice: when the client changes the contract partway through. Clients often request scope changes, like better finishes or additional features. When this happens, the contract price is adjusted prospectively, and revenue is recalculated going forward. Example: original $3 million contract reduced to $2.6 million in year 2. From that point on, all revenue and profit are recalculated using the new contract price. Let's pull everything together with some closing thoughts. Now that we've gone through how long-term construction contracts work in detail, let's take a moment to compare IFRS and ASPE. This is a common exam question and a real-world issue for Canadian accountants. Under IFRS, if you cannot reliably estimate the outcome of a long-term contract, you must use the cost recovery method. That means revenue is recognized only up to the costs incurred, with no profit recognized, until the outcome can be measured reliably. Under ASPE, there's an important difference. Instead of cost recovery, ASPE allows the use of the completed contract method. The completed contract method would only be appropriate when performance consists of the execution of a single act, or when the enterprise cannot reasonably estimate the extent of progress toward completion. This means no revenue, expenses, or profit are recognized until the contract is finished. Payments received from customers before completion are recorded as unearned revenue, often shown as progress billings. Costs incurred are recorded as an asset, contracts in process or contract asset, as long as they're recoverable. So the key distinction is this: IFRS, cost recovery method, recognize revenue equal to costs, no profit. ASPE, completed contract method, defer everything until the end. This difference can create a timing gap between IFRS and ASPE reporting. Under IFRS, you'll see some revenue appear earlier, even if it's just matching costs. Under ASPE, nothing shows until the job is completely done. And with that, we've now covered the mechanics, the 4-step method, how to handle losses and modifications, and the key IFRS versus ASP differences. Let's wrap this all up. long-term contracts can be accounted for under cost-plus or fixed-price arrangements. Fixed-price contracts follow a four-step method: estimate profit or loss, determine percent complete, calculate revenue, and recognize cost of goods sold. Cost increases may create temporary losses. Onerous contracts require recognizing losses immediately. Contract modifications are handled prospectively. And finally, IFRS uses cost recovery when estimates aren't reliable, while ASPE allows the completed contract method. And that's the complete picture of long-term construction contracts under both IFRS and ASPE. These differences are crucial to understand for both your CPA exams and your professional work. If this video helped, give it a like, share it with your classmates, and don't forget to subscribe to Canada Accounting Insights for more deep dives into IFRS, ASPE, taxation, and finance. See you in the next video.